Hello and welcome to this Independence Day special edition of ICICI Prudential Mutual Fund and CNBC TV18.com present Smart Investor. This is an e-forum, a very interesting setup where we bring you some of the best industry voices so you can make sense of your finances, learn all about financial independence, and see what are the products in the market and how mutual funds can help you realize a lot of your ambitions, your goals, and your dreams. Well, as I said, the topic for this particular webinar is financial independence. And my guest on the show is Chintan Haria, who is the head of product development and strategy at ICICI Prudential Asset Management Company. Chintan, many thanks for joining in. And I'm very happy to see that you're also donning the flag, as am I. And we want to start by wishing everybody who's logged in and who's watching us on this cast a very, very, very happy Independence Day. So, Chintan, first question to you: what does independence really mean when you talk about money and finances?
So, thanks, Surabhi, and wishing all the viewers a happy Independence Day. Financial independence, of course, it simply means that you should not worry about your where your next income is going to come from for your next expenditure, essentially. So, maybe over 1 year, 2 years, 3 years, 4 years, when you look at yourself and going all the way up to retirement, you should be very, very clear as to what is your goals and how are you going to meet your goals from the perspective of saving and investment. So financial independence to me is very simply, I don't have to worry about money and where I'm going to find the money for my next expenditure. That's simply what independence is.
Oh, yeah, that's really well put. And I couldn't agree more. I mean, I'd like to just add one line. I always think that if, every one of us has a dream, whether it's a house or a vacation or a great general comfortable life. And I guess the means of achieving that dream has to be financial independence. But now, Chintan, let's start, taking this one by one. A lot of people might think that you can be financially independent only if you make a huge pot of money, if you're a massive salary earner. But that's not necessarily always the case, right?
Absolutely. So every drop makes an ocean eventually. And the key to financial independence is essentially starting early. It's not something which is taught in our schools, but the lineage which we have, the cultural heritage which we have, very pertinent around Independence Day time, that in India, we've always learned the virtue of savings. And I think the virtue of savings has meant that we've always been a saving country. And it has given financial independence to most of our ancestors, etc. And even if you are a small salary earner, it does not matter, small or big. Once you start investing and that investment grows to the power of compounding, it essentially leads to a corpus which is sufficient enough from your standard of living when you basically retire.
Yeah. Just another point in this, and I thought of it as you were talking. In India, we also are blessed to have, usually a pretty strong family tradition, a family system. Sometimes can that get in the way because parents at times are okay being dependent on children? Close families is quite happy to be dependent on someone else in the family. While that's great, I'm guessing a certain degree of independence is also something that one needs to inculcate. Would you agree?
Yeah, that's true. I mean, from that perspective, being in a joint family or supporting each other is a great thing because it essentially ensures that everyone grows together. Not all of us are made similar, right? So that helps. But to each one is own each one. And now we are moving to a situation wherein nuclear families are the order of the day. So the joint family system is behind us. So we have to plan, I think, from single income to double income, from double income to double saving, plus, of course, all the expenditures that are there. So yes, we must do that from a perspective of saving each individually.
Yeah. So that brings us to the first question, the first real hard question. The concept of saving and the concept of investment, and a lot of times these two words are used interchangeably in language and in our communication. How would you describe each one of them?
Sure. So they're very different. Saving is essentially what comes from what we are earning or what we already have, and what we don't spend is what we save, right? But investment is a completely different story altogether. Investment means taking that decision where your money should get invested, in which asset class, at what point of time. And that involves a lot of understanding of what are the options that you have in terms of investment, what is your own asset allocation strategy or profile. And I think that, again, is not something which is told. We need financial advisors to help us on that. But I think with growing education, much the same way as we are going to do over the next 30 minutes, it is helping investors to actually get a sense of what they should be doing in terms of investments. So investments essentially is different from savings. Savings is what we save from our own earnings, and investments is the decision that you make to choose the asset class where you want to invest and allow it to grow over a period of time.
Oh, absolutely. And by the way, to all our friends out there, if you have any questions, any queries on how to manage your money, financial awareness, financial independence, please keep sending the questions, the queries. We are going to be taking them live. Chintan is right here, and he'd be happy to answer some of those questions. So make sure you keep the queries flowing in. Chintan, before we get on to the topic in more detail, I just want to get your sense. I mean, at ICICI Prudential Mutual Fund, you would be interacting with a wide array of investors, right? So when we talk about an initiative like Smart Investor, what exactly is the bent of mind with which you come forward, and what do you find in terms of the average awareness levels when it comes to retail investors?
So I wouldn't club it only retail. I think retail, HNI, all investors, right? All investors categories, they're good at whatever their business is or their profession is. But investing doesn't come naturally to all of us. It's whenever we talk of money, a lot of emotion and fear comes in. You would have seen that in the last actually 6 months. It has beautifully showcased itself. Wherein in January the market levels are a bit different. In March, whatever happened, the market fall, people got afraid. People started moving out in March. Many of that. So from a perspective of investors, I think greed and fear is what we've seen over the last, at least in the last 15 years that I've been part of the market, both on the investment side and on the product side. And in the last 5 years, I've interacted a lot with investors. It is one thing which is common. Greed and fear is affecting a lot of us. And to avoid the greed and fear, the financial knowledge and the financial freedom is important. And that's what we're trying to do with this Smart Investor initiative, wherein we tell investors that don't keep on looking at your investments every now and then. Don't allow the surrounding environment to impact your investment decisions. If you basically chosen your path and you've decided or have had a decision earlier on asset allocation and what you're going to achieve, basically goal-based planning, it does help investors to stay away from the greed and fear and avoid making mistakes in investing.
Hmm. Okay, so now let's come to the planning part, and that's so important when it comes to matters of money, right? Now, if my goal is financial independence, say, by a certain age or, 10 years down the line or 15 years down the line, how do I begin? What's the first step?
So the first step is essentially by not necessarily cutting your expenditure, which is important. But what we've seen in the last maybe 10 years or so, in line with the consumerism, our savings rate has come down from 25% to 15%. That savings rate coming down from 25% to 15% has meant that we are saving much lesser than what our earlier generations were doing. And that means we have lesser savings for future investments. So I think the first step is try and save as much as you can by cutting out all the expenditure which may not be necessary. And from a perspective of an investor, I think the smaller the savings does not matter, but save it and then start investing in it. That's the start, I would say.
Okay, great. Got that point. So let's move to then step two. Now you figured out your pool of capital. I mean, you figured out your savings, how much you can put aside every month. Then comes the next step, the transition to investments, Chintan. And here is where people, either because of lack of knowledge or awareness or lack of confidence or just sometimes sheer laziness, people don't put their money to work. It keeps lying in a savings bank account at a, 3.5% rate of interest. So how to break this barrier?
So I think the first step to breaking this barrier is putting effort to understand financial investments. So traditionally, of course, in India, we've seen real estate, because of the family legacy, and gold have been two asset classes where investors or people have been investing. It's a cultural thing. But financial investments are not something which people put an effort to learn. So it is important to learn what are the options of financial investments that are there. And their mutual funds, of course, are playing an increasing role in terms of not just availability of options for investor to invest, but also the way in which they are being managed. So I think that one thing of awareness is extremely important from an investor perspective as to what are my options available for investing.
Sure. So let's talk about the role of mutual funds in more detail then. And, these days you get mutual funds offering a lot of goal-based solutions as well. And tell us a little more about that. I mean, I keep hearing about how you can look at retirement through mutual funds. You can look at, planning for your children and creating a corpus for your children. So, how do you segregate your goals and then how do you start investing and preparing to meet those goals?
Correct. So, say the median age of India right now is somewhere around 28 to 30 years old. So, that's where most of us, I mean, the majority of Indians, and they're just about 5 to 6 years into their career in terms of earning. And for most of them, they can start early and they can start investing. And like you said, there are enough options around mutual funds which are available. I would say first part of asset allocation is essentially where you should invest, whether it should be equity, debt, and within equity debt, how is that determined, right? How does an investor decide how much of his money should go in equity, how much of his money should go to debt? The answer is not that simple. People do have that formula 100 minus the years of age. But I think that has also aged in the sense that with the ever changing world, wherein because of whatever is happening with central banks' infusion of capital, the volatility in the markets is too high. So I would say that 100 minus age used to work earlier. But we believe strongly that asset allocation as a category, which is the dynamic asset allocation fund category and the balance advantage fund category, that's more suited for equity investment for general investors who really do not have the time or the knowledge of actually following the market. So we are firm believers of that. And on the debt side, of course, I would say that people can keep it very simple. They can invest, save, even on the debt side. So it would be surprising to note that most people think mutual funds are only about equity, but I think debt mutual funds are a larger part. And I think investors should definitely take advantage of the fact that it is very easy to invest in debt mutual funds also, and their debt allocations can be part of the mutual fund bucket, and there are enough options there as well. Because when you're investing in a debt mutual fund in a falling interest rate environment, you do end up getting the uptick, because when the interest rates fall, generally the bond prices go up and you get the advantage of that. So not just equity, but also debt options are available. The percentage of investment, how much should be, it depends on your income profile, your responsibility profile. So if, for example, 30-70 works for me, 30% equity, 70% debt works for me, it is not necessary that someone who is the same age as me should have 30-70. They may have 20-80, or they could have probably 100% in equity as well. So if you look at India versus the US, just as a number point, we as a saving country have only 4.5 or 5% of our savings in equity today, while US has about 40% of their savings in equity today, in equity today. So that's a very big gap that is there. We are filling that gap by more and more people getting invested in the right manner. But I think getting invested in the right manner is the key over here, which we can probably discuss as we move along.
Oh, yeah, absolutely. I mean, and I completely go back to the very first point you made, awareness and the willingness to understand these products. It's so important, right? Because increasingly the financial world is also becoming slightly more complex. There are lots of choices, and there's no point going crying later or blaming someone else if you've made a choice which you weren't really fully informed about. So I think that's 101 of knowing what you are getting into. So let's talk about equity as an option, Chintan. And now things are evolving so quickly. I mean, 5 years back, the concept of exchange traded funds, for instance, was very alien to a lot of Indian investors. But now, these are products that are coming on the horizon as well. So if one is looking at their equity investments, then how should they use the mutual fund route effectively? Because then there is this active or passive. Do you want a human fund manager actively managing your money, or do you just want to track the index? That's also an increasing question that's coming up.
So I'll break this into two parts. The first part being what is equity, because I think people generally do not understand what does equity investing mean. Equity investing means you are becoming a part owner in a company. You are becoming basically the owner of the company in which the investment is happening. And each company is impacted a lot by so many factors which are working around the interest rates, the demand supply. You see obsolescence happening and hurting companies which were large 20 years back, and today they are no longer in business. At the same time, 20 years back, there were certain companies which were non-existent, but today they have become very large companies because of the technological improvements. So can an individual investor understand all these things? The answer is no. I mean, it takes a lot of research. You have a lot of time spent with the companies to understand these companies. You have to go through their balance sheets, which is not easy for an investor who's not trained. And that's where I think mutual funds come in very effectively in trying to ensure that you get a portfolio, a diversified portfolio of stocks, which is curated for the investor depending on the investor's requirement, depending on the category of investment that the investor chooses. So you should become a partner in business through equity investing and keep that money for long periods of time. think of it this way: when you are doing your own business, very rarely would you believe that I want to get rid of that business in 1 year's time, 2 years' time. But that's what people end up doing in equity. They invest today thinking that they'll make money in 1 year's time, and that's where they end up going wrong. So I think from a first step perspective for investors in mutual funds, systematic investment plan is a great tool to start investing. You save every month, you invest every month. That investment, what the part which needs to go to equity, can start going to equity via systematic investment plans. And which mutual fund to choose within equity, I would say that is dependent on each individual. But we at ICICI Prudential Mutual Fund believe that over a long periods of time, if an investor is a conservative investor and doesn't understand too much about investing, then definitely the dynamic asset allocation category, or the balance advantage fund category as it's called, is something which an investor should start investing with, and then move on to the various categories like large cap, mid cap, small cap. Small cap, for example, are those stocks which are very small. They may be single product companies, and they can be volatile as well. So a new investor may not suddenly want to go into small cap, but at some point of time, after learning the entire curve, yes, there is definitely a case for an investors to start building a small cap investment over time, and then know when to remove also. So investing and divesting both are important, and I think from that perspective, the dynamic asset allocation fund category goes in handy in the hands of investors.
That's really interesting. You mentioned that, and I'm guessing these funds, dynamic asset allocation, as the name suggests, they keep shifting between, the equity and debt mix, right? Tell me if I'm wrong over here. Typically, what's the formula that's applicable? And I'm sure you guys would have tracked the data for many, many years. In terms of returns, do these funds end up throwing better, more stable returns on a longer time period horizon?
So, for example, you're right. Dynamic asset allocation as a category is based on. It could be based on many factors. Many mutual funds have it. It could be based on many factors: price to book, price to earnings, etc. So you can have different models for essentially allocating between equity and debt. The good part is when it essentially does very simple thing: buy low and sell high. In other words, when the markets are cheap on valuations, it may end up increasing your equity allocation, which is how it should be. Let's remember here, most investors think exactly the opposite. When the markets are actually high, you end up investing more. So I think many of your listeners will also resonate to the fact that 2017, they had much more investments, or they were happy to invest a lot more because markets were doing very well. Then markets came down in 2018-19 on the mid and small cap space. They kind of withdrew from the market. So I think from the perspective, if an investor wants to participate in the market, the dynamic asset allocation category, which basically moves between equity and debt in a very simple way, buying low, selling high, in such a manner that they endeavor to try to reduce the downside of the investor, exactly what you mentioned, try to protect the downside of the investor, because when markets are expensive and if you have lower equity, you fall that much lower. And not just that, you get the advantage of averaging when the markets fall, right? So when the markets fall, then the fund will end up buying more from the investor because the equity levels will increase. To put it very simply, buying low, selling high, protect downside, participate on the upside. That's the mantra of generally the dynamic asset allocation category.
Okay, so that's how dynamic asset allocation funds work. Got that. Now, just a word on debt, because you mentioned that obviously, mutual funds have a lot to offer on the fixed income side as well. But I think, unfortunately, we've had certain scares in that part of the market, and it's been the case since 2018 because of certain financial events that are going on in that side of the market. So, for a lot of people who were just about building up the appetite to start moving some of their fixed deposit money into mutual funds, what should the lessons and the learnings be, and how should they invest wisely without getting burnt?
Sure. So the first thing is that be it equity or debt, investors should not look at past returns and invest. I would say that that is not the right way to invest. Second is, ideally, the way we have a doctor for our physical health, we should have a financial advisor for our financial health as well, because we may not necessarily have the time to follow everything. And I think financial investment do require a certain amount of time to be spent in understanding. And then that will avoid all the issues which you mentioned. There are chances that some of the problems which have happened with investors, they may have not happened if they would have had a good financial advisor on their side. And second, on the aspect of mutual funds, how to choose a debt mutual fund, I would say there again, there are different categories, and they are well-defined categories as per regulation. And if we see from a regulatory perspective or a definition perspective, there are just two things on the debt side. One is what is the quality of paper, or what is the credit quality of the paper that is there in a fund. and what is the duration. How much is the maturity? 1 year, 2 year, 3 year, 4 year. So generally, if you see, there are funds which are investing only in AAA. There are funds which are investing below AAA also. And today, as the market stands, the liquidity is so strong in the market that the AAA funds are basically investing, or rather, AAA funds are returning lesser because a lot of money has gone into AAA. So the yields or the interest rates on AAA papers, the safety, as we call it, the safe papers, has come down very sharply. And hence, from an investor perspective, they should have a fund which has a blend of, let's say, below AAA also, as long as the fund is managed in a good manner. So I would say that the accrual category or the credit space is something which today is offering a slightly higher return. And if it is managed well, the risks are managed well from a portfolio perspective. I think that's the space where investors will end up getting better risk-adjusted returns, because otherwise the interest rates are heading down and they are very low for the high quality bucket, as we call it.
Yeah, absolutely. And then a lot of the savers who are still putting their money with banks, they would agree that, a net of inflation, pretty much you get nothing in hand. So everybody is looking for an alternative. Okay, now to come to some of the life goals, and we briefly touched upon it earlier, Chintan. For instance, let's say retirement, and this is a question that always comes up: that do I need to invest in funds which cater specifically to that need, or are called retirement oriented funds, or is it okay if I'm just in a diversified mutual fund, whether it's a multi cap or a large cap? Do you need to invest in separate products to meet separate goals?
So the way we are wired as individuals, if I have put money in a retirement fund, my mind will always stop me from removing that money when the markets fall. Because in retirement fund, I have this money set for my retirement. Let's not pull it out, right? That's how we are hardwired in our mind. And if I put the money somewhere else, for all you might know, it may come out. So when it is goal based, it definitely helps. So it could be a simple goal like, okay, in 3 years' time, I want to buy my first car. Let me start saving 5,000 rupees in an X mutual fund, which will grow at an X percentage, and I will be there. So those calculations can be done, and that is goal based. It could simply be at the age, if I'm 30 years of age and I need to be at 60 years, you spoke of retirement. Today, if you're spending 1 lakh rupee a month, through sheer percentage exposure, because of inflation, which you mentioned, if I calculate a 5 or 6% inflation, you will need approximately more than 5 lakh rupees at that point of time per month. So what is 1 lakh today will become requirement of 5 lakh by the time you're 60, after 30 years of age. So accordingly, you'll need to save. If you do the backward calculation, you'll need to have a corpus around 10 or 12 crores at that point of time. And if you need a corpus of 10 or 12 crores at that point of time, and I don't even know what the interest rates are going to be after 30 years, because if you see the past 30 years, interest rates in India itself have come down from 14 to maybe 6, 7%. And globally, be it Japan, US, and because I assume 5 or 6% interest rates. If I assume 5 or 6% interest rates, then maybe 10 to 12 crores. So you need to save a bit.
Okay, so therefore, that is how perhaps some of the goal-based products can be of a little more help. Just to get back to the concept of financial independence, I mean, apart from retirement, that's a long-term goal, obviously, where you really do need to make sure that you're independent and not looking towards someone for your financial needs. How is it important even in the earlier stages of your life? I mean, how would you look at some of these investing decisions as you take your step towards, let's say, marriage or children as you move forward?
Yeah, so no doubt about it. In fact, I do try to teach that to my 10-year-old son as well, that it is important to save and it is important to invest. I'm starting to teach him investments to the extent that I can, because the earlier you start, the better it is. And because probably I'm from the financial industry and that's all what I've done all my life, I'm able to teach him. But yes, I would say the first step, and I strongly believe in that, is that each child, if or each parent, grandparent can have a systematic investment plan created in the name of the child, right? Be it a minor child, it doesn't matter. And then when the child will grow, it will be hardwired, and the child can see actually that, okay, this is the corpus which has been built by my grandparent or my parent for me over time by investing through this. It will be a good learning by the age of 12, 14, because we need to start early. We don't have a choice in a competitive world where we don't know how the landscape will change in terms of jobs, etc. At least from our end, if we can save for our children and leave a legacy of learning how to save, it will be good. However, if I'm already there in terms of, okay, I've just got married and I need to probably plan for my future children, etc., Those are the shorter term goals which you can plan for yourself, 5-year, 10-year goals. And like I said, you divide between equity and debt, your investments, or you invest simply in dynamic asset allocation fund as a category and allow the fund manager or the asset management company to decide what is the right proportion for you. But there again, any equity investment, you need to have a horizon of at least 3 to 5 years. Don't think that in 6 months you'll make money and get out. That's not how equities work.
Absolutely, no, that's a point completely taken. But I mean, on the subject of when to get out, and that's rarely discussed, right? Because while it's okay to have the fill it, shut it, and forget it approach, maybe that's more easier or easier for retirement and those kind of very long term goals. Now, for slightly shorter term money needs, 3 years or 5 years, we've seen investors have this complaint. Specifically, let's say you mentioned mid cap funds. I mean, if you remained invested over a 10-year period, and if you today you look at returns, you'd probably wonder, oh, it's just 5, 6, 7%. Whereas if you managed to exit when the market was in its heydays, then the returns would have looked much, much better. So should one bother about the exit timing at all?
Yeah, so it is said that buying is a science while selling is an art. It is very difficult to time the art part of it. But yes, I would say any asset class which gives supernormal returns in the past, uh, the mind works in a manner that I want to enter that. You would find in I mean, if you see in the last 1 month or 2 months, the kind of queries that would be coming on bullion, gold, silver, if I may say so, may have increased. You would have also heard a lot more about gold and silver.
Because
But
you have
from
the
an
missing out feeling, right? You think, oh, I've missed out on the rush. Can I still join in? That's the
correct.
typical human mindset. Yeah.
Correct. So I would say that investors who invest with past returns in mind, they are the ones who actually get burned because everything in the markets have cycles. And I think the learning of cycles again is not something which is taught to us. Courtesy me being in part of the asset management company where we very strongly believe in cycles, and I've learned that a lot from our fund managers and our CIO, that markets has cycles and you have to basically believe in those cycles at different points of time. So don't rush into an asset class which is doing well. But like you mentioned, 2017 mid caps valuations had become too expensive. Should you not have come out of mid caps at that point of time and moved into safety, into something else? Yes. Again, it's not taught, and that's where a financial advisor, a person who can help you with your finances, becomes extremely important.
Yeah, or as you mentioned, I mean, the dynamic asset allocation funds, because when the human mind sometimes cannot think rationally enough and cannot take that exit decision, a well-regulated product like that perhaps it can do it for you. So I take your point on the balanced
Yes, and
advantage.
the fund manager there would also probably do that in terms of going away from the expensive names and going into probably the more safer names, if I can use that, or the cheaper names, so that at least when the expensive becomes falls very sharply, you don't get hurt as an investor. And that's where mutual funds, which have the expertise around it, are a better way to start investing. And then if you learn and you want to dwell on your own, it's a different story. But to start with, definitely it helps to start with the dynamic asset allocation fund category or the balance advantage fund category as it's called.
Okay. Well, Chintan, that's a lot of questions that I've thrown at you, but I'll tell you what, we have some queries coming in from, the viewers as well. So let me just take some of them at least. This first question is coming in from Anish Chadha. Anish says that I'm a 28-year-old engineer working with an MNC with a decent pay, but I have a couple of loans that I need to pay off. I need tips for smart budgeting, how to start paying off my loans slowly. Any advice here?
So yeah, one aspect which we did not speak of was taxation. Probably, I think taxation becomes a very important aspect of any investor on their planning. So, for example, if the loans which he is mentioning, they have a certain tax component to it or tax exemptions. For example, housing loans have tax exemptions. Then he has to basically mark that out that okay, I'm getting exemptions on that, so I can continue with that loan. The other aspect is the interest rate on the loan itself. So, for example, if your interest rates on the loan is much higher than the what you're getting if you keep the money in the other asset classes. If you have any interest loan which is higher, you may want to probably balance that out as well. You can't be paying too much at the same time you're getting less, right? So I think taxation and the interest rate which you're paying become a important aspect to them.
Okay, all right. Let's move to the next question, which is from Sandhya Munshi. Sandhya says, how to save money on a low income to be financially free? Additionally, how much money should I have in my emergency fund? This is an important point. We didn't touch upon this, especially as for someone who's not a very high earner immediately right now. How do you start, and how do you ensure that you have that emergency corpus, Chintan?
So I think emergencies can be medical emergencies or otherwise. For medical emergencies, of course, I think the health insurance, etc., is something which all of us, either because of our jobs, have it, or we have to take it ourselves. Otherwise, I think from an emergency perspective, life being very unpredictable in such a scenario. For example, if you end up losing a job, or temporarily you end up losing a job, it's not permanent. I think it's good to have 6 months of expenditure saved at all points of time in very liquid investments, so that you can dip into them in case of emergencies. I think that is one yardstick which is very important, because generally in 6 months things do normalize, and even if you have a temporary issue, it can be sorted. So I think a combination of both, having the right insurance as far as health is concerned, because that can be a crippling effect, as well as investments in either liquid funds or an equivalent short-term funds, low duration funds, which can help if there is a temporary requirement to dipping into emergency funds.
Okay, absolutely. Yes, COVID-19 has taught us that insurance is of paramount importance. And we've seen that. We've seen the rise in, of course, insurance penetration in this crisis as well. Moving on to a question coming in from Vipul Nath, who says, what are the ways in which we can invest in specific solution-oriented mutual funds? Chintan, we did touch upon this briefly. What are some of the interesting products that the industry has on offer?
So if you look at it, there are retirement plans, and within retirement plans, of course, you have pure equity. You could have hybrid, which is a mix of equity and debt, and pure debt as well, right? So that's something which an investor can choose, where the investor wants to invest the retirement. So that is one category which is goal based, and I think the longest term. The other is for the children. You have a children category, or the child care category, as it's called, wherein the investment can be made in the name of the child, so that not just the corpus is created for the child is also inculcating the habit of saving and learning. So I think from that perspective, child oriented funds are there. Otherwise, like I said, the goal oriented solutions, there are enough in the market in terms of how you can have investing for a period of time, and then you have systematic withdrawal plans which you can take as an annuity, or I wouldn't say annuity, but you can take out every month, so that you save for the next maybe 10 years, and after 10 years, whatever corpus you build, you take out via systematic withdrawal plans. That is also something which is catching up very well with investors, because it's essentially saving, allowing the corpus to grow, and then taking out money on a monthly basis to support your requirement from an investing perspective.
Chintan, our next question is actually linked to this. This is from Sandeep Arora, who says, how can we distinguish between financial freedom and regular retirement? Lots of questions coming on retirement. And let me throw in a question from my side as well. There are a lot of people who've created a corpus over the past many years, but they might not have gone the mutual fund way till very late, till maybe they were 55. They're new to the mutual fund world. So if someone is at 60 and finds themselves with a corpus which they need to, last out for the next 20 years, expecting that you live till 80, then how can mutual funds help?
Sure. So clearly, if one is at 60 years of age and has not been an equity investor in the past and wants to start investing in equity, they can start with the equity savings category, which has low equity. Then there is the balance advantage fund category, which may be the higher equity. But at 60, someone may choose that they don't want to invest in equity, which can be in a lower or falling interest environment. It may not be the right thing, because one thing which you mentioned, that last 10 years, investors have not made money in general, because in general, the market returns have been single digit from a perspective of equity markets. That may change for the next 10 months, because the cycles of markets are such that 2000 to 2010 was good, 2010 to 2020 was a consolidation, maybe 2020 after the pandemic, with the growth, GDP growth improving, there is a chance that the markets may be better in 2020 to 2030 period. So at a time when interest rates may be falling, or maybe flattish or low. So a 60-year-old investor, I would say, there is an option to invest in good quality debt mutual funds as well, I would say. And like I said, a mix of AAA, AA, and if it is a well-managed fund, the entire credit risk category or the bond category, or the accrual category as it's called, wherein there is a slightly higher return compared to the safety net of AAA papers or lower duration, or just pure AAA papers, the yields are very low. So I would think that the investor can start with. And again, I would reiterate the importance of having the right financial advisor to guide you through this
Sure.
process.
Okay, got that. Well, we have time for just one more question. Let me try and squeeze this in as well. Suman Kazi says, looking at the current job market and income uncertainty, what should be my immediate goals on my road towards financial freedom? I think this is important. A word for the young people out there as well, Chintan, who are anyway looking at so much of uncertainty and then trying to balance out their expenses with their investments, with their savings. What would your advice be?
Yeah, so all the young people, I would like to say one thing that as far as the world is concerned, there will be uncertainties and volatility. But as far as India is concerned, because we are a young country, because we are a young nation, we have a lot of opportunities which will open up. So as long as you specialize yourself, your skills in a particular manner by hard work, of course, going to be a lot of competition, but you have to specialize your skills, and it's going to be a skill based job oriented industry as we move along. And the second aspect is essentially ensuring that you do not, even if your parents have money, and even if you are have access to your parents money, do not spend it on things which you may not necessarily need at this juncture. It's very easy to spend on many options that today we have on consumerism, but I would say saving as a virtue would help us, and start investing, because the moment you start investing, I think you will probably get hooked onto it so much that the saving part will automatically be taken care of.
Okay, well, I think those are some very, very interesting and important points. Chintan, thank you very much for taking out the time and giving us your sense, your interpretation of financial freedom, and how we can start at least walking towards it and building a plan towards it. I hope this has been really helpful and useful for our viewers. Thanks very much, and viewers, please keep your questions coming in, flowing into us. Until the next time on the next episode of Smart Investor.
Thank you, Surabhi.